Question 1. Which of the following is not a primary function of reinsurance? A. Risk management. B. Capital relief. C. Profit stabilization. D. Increased competition in the market. Answer D. Increased competition in the market. Explanation. Reinsurance is primarily used for risk management, capital relief, profit stabilization, and increasing capacity. Its role is to help insurers manage risk by transferring some of their exposure to another party, typically a reinsurer. While reinsurance may indirectly impact competition in the market, this is not one of its primary functions. The other options, risk management, relief, and profit stabilization, are core objectives of reinsurance. The role of reinsurance is to provide insurers with financial stability, help them manage their risk exposure, and increase their ability to underwrite larger risks. Question 2. Mr. Thompson is a reinsurer assessing a potential treaty agreement with an insurance company. He is trying to decide whether to enter into a quota share agreement or a surplus share agreement. What factors should primarily guide his decision in choosing between the two types of agreements? A. The reinsurer's need for higher capital relief. B. The volume of premium the ceding company generates. C. The reinsurance company's loss history. D. The level of risk exposure of the underlying policies. Answer B. The volume of premium the ceding company generates. Explanation. The primary factor in deciding between a quota share agreement and a surplus share agreement is typically the volume of premium that the ceding company generates. A quota share agreement involves the ceding company sharing a fixed percentage of the premiums and losses with the reinsurer, regardless of the individual risks. This type of agreement is generally more straightforward, used for managing higher volumes of smaller risks. In contrast, a surplus share agreement is often used when there is a higher volume of larger risks and the reinsurer takes on a proportion of losses exceeding a certain threshold. The other options may be considerations in broader decision-making, but the volume of premium generated by the ceding company is the key factor. Question 3. Which of the following statements about catastrophe reinsurance is true? A. Catastrophe reinsurance covers all types of natural disasters without any limits on coverage. B. Catastrophe reinsurance typically involves excessive loss coverage where the reinsurer pays for losses above a specific threshold. C. Catastrophe reinsurance is only used for property insurance policies. D. Catastrophe reinsurance can only be triggered by a declared state of emergency by the government. Answer B. Catastrophe reinsurance typically involves excessive loss coverage where the reinsurer pays for losses above a specific threshold. Explanation. Catastrophe reinsurance is typically structured as excessive loss reinsurance, meaning the reinsurer pays only for the losses that exceed a predetermined threshold. This is crucial in managing the financial risks associated with large-scale catastrophic events, such as earthquakes, floods, or hurricanes. Catastrophe reinsurance does not cover all types of natural disasters without limits, as each agreement will have specific terms and conditions, including coverage limits. Additionally, it is not restricted to property insurance policies. It can be applied to other lines such as casualty and life insurance. The occurrence of a catastrophe does not necessarily require government declaration of emergency for the coverage to be triggered, as long as the event meets terms set in the reinsurance contract. Question 4. Which of the following is a key difference between proportional and non-proportional reinsurance? A. In proportional reinsurance, the reinsurer assumes a fixed percentage of the premium and losses. In non-proportional reinsurance, the reinsurer pays for losses exceeding a specified amount. B. In proportional reinsurance, the reinsurer covers losses beyond a threshold. In non-proportional reinsurance, the reinsurer shares premiums and losses equally. C. Proportional reinsurance is typically used for catastrophe coverage. Non-proportional reinsurance is used for daily operational risks. D. Non-proportional reinsurance typically involves the insurer taking on more risk, while proportional reinsurance is less risky for the insurer. Answer A. In proportional reinsurance, the reinsurer assumes a fixed percentage of the premium and losses. In non-proportional reinsurance, the reinsurer pays for losses exceeding a specified amount. Explanation. The key difference between proportional and non-proportional reinsurance lies in how the losses and premiums are shared between the ceding insurer and the reinsurer. In proportional reinsurance, the reinsurer receives a fixed percentage of premiums and covers a proportional share of the losses. In non-proportional reinsurance, the reinsurer pays only when the losses exceed a specified threshold, often referred to as an attachment point, and typically handles larger losses. This distinction defines the risk-sharing mechanism and coverage scope for each type of reinsurance. Question 5. What is the main purpose of the follow the fortunes clause in reinsurance agreements? It ensures that the reinsurer follows the decisions made by the ceding company regarding claims settlements. B. It dictates that the reinsurer will cover claims as long as the ceding company remains financially solvent. C. Ensures that the reinsurer must pay for losses even if the ceding company has not fully complied with regulatory requirements. D. It guarantees the reinsurer will pay claims even if the ceding company has violated the reinsurance agreement. Answer A. It ensures that the reinsurer follows the decisions made by the ceding company regarding claims settlements. Explanation. Follow the fortunes clause in reinsurance agreements ensures that the reinsurer will adhere to the claims decisions made by the ceding company as long as the decisions are made in good faith and according to the terms of the original policy. This clause reflects the principle of honoring the cedent's judgment, providing the reinsurer with the assurance that they will not second-guess claims decisions. It protects the ceding company from disputes with the reinsurer over claims handling, assuming the cedent has acted within the scope of the original agreement. Question 6. Mr. Harrison, an insurer, is seeking reinsurance to help stabilize his financial performance and reduce the impact of large, unpredictable losses. Given the goal of reducing the volatility in his financial statements, which reinsurance structure would be most suitable? A. Quota share reinsurance. B. Excessive loss reinsurance. C. Surplus share reinsurance. D. Stop loss reinsurance. Answer. B. Excessive loss reinsurance. Explanation. Excessive loss reinsurance is designed to stabilize financial performance by covering large, unpredictable losses. Under this structure, the reinsurer agrees to cover losses above a certain threshold, which helps the insurer manage catastrophic events that could otherwise severely impact their financial stability. This type of reinsurance is specifically aimed at reducing volatility by limiting the insurer's exposure to extreme losses. Quota share and surplus share reinsurance focus more on sharing premiums and losses proportionally, while stop loss reinsurance applies to different situation where the reinsurer covers losses once they exceed a specific aggregate amount. Question 7. Which of the following would not be considered an advantage of using reinsurance as a capital management tool? A. It provides capital relief by transferring part of the risk to the reinsurer. B. It allows the insurer to reduce its required solvency margin by shifting risk to the reinsurer. C. It eliminates the need for the insurer to maintain any reserves for future claims. D. It enhances the insurer's ability to take on more business and write more policies. Answer. C. It eliminates the need for the insurer to maintain any reserves for future claims. Explanation. Reinsurance does not eliminate the need for an insurer to maintain reserves for future claims. Insurers are still required by law to maintain sufficient reserves to meet their future obligations, even if some risk has been transferred to reinsurers. However, reinsurance does provide capital relief by transferring part of the risk to the reinsurer, allowing the insurer to reduce its solvency margin requirement and write more business. The primary advantage of using reinsurance as a capital management tool is to enhance the insurer's capacity to handle more business and absorb larger risks without significantly increasing its own capital requirements. Question 8. Which of the following is not typically a component of reinsurance accounting? A. Reporting reinsurance premiums received. B. Accounting for reinsurance recoverables. C. Reporting the reinsurer's share of claims and losses. D. Adjusting the ceding insurer's profits to reflect reinsurance commissions only. Answer. D. Adjusting the ceding insurer's profits to reflect reinsurance commissions only. Explanation. Reinsurance accounting is a complex process that involves tracking premiums received, reinsurance recoverables, and the reinsurer's share of claims and losses. Adjusting profits to reflect only reinsurance commissions would not encompass the full scope of reinsurance accounting, which also requires accurate reporting of premiums, claims sharing, recoverables. Reinsurance commissions are important, but they are just one part of the financial picture when accounting for reinsurance transactions. Reinsurers and ceding companies must both adhere to detailed financial reporting guidelines to ensure accurate representation of their financial positions. Question 9. What is the main regulatory reason that reinsurers must meet solvency requirements? A. To ensure that reinsurers are able to pay claims as they become due. B. To prevent reinsurers from overpricing their premiums to remain competitive. C. To ensure that reinsurers have sufficient surplus to fund expansion efforts. D. To protect the reinsurer's shareholders from financial instability. Answer A. To ensure that reinsurers are able to pay claims as they become due. Explanation. Solvency requirements for reinsurers are primarily in place to ensure that the reinsurer has sufficient financial resources to pay claims as they become due. This is crucial for maintaining the stability of the reinsurance market and for protecting policyholders who rely on reinsurers to honor their obligations. While solvency requirements may have second effects on pricing, expansion, and shareholder protection, the central goal is to ensure that reinsurers remain financially stable and able to meet their claim obligations in the event of significant losses. Question 10. Which of the following types of reinsurance agreements is best suited for insurers looking to limit their exposure to catastrophic risks? A. Quota share reinsurance. B. Surplus share reinsurance. C. Excessive loss reinsurance. D. Facultative reinsurance. Answer C. Excessive loss reinsurance. Explanation. Excessive loss reinsurance is designed to cover large catastrophic losses that exceed a specified amount. It is particularly beneficial for insurers looking to protect themselves from the financial impact of large-scale events like natural disasters or large claims. This type of reinsurance does not share a proportional amount of premiums and losses. Instead, it focuses on covering excess losses above a certain threshold, making it ideal for managing catastrophic risk. Question 11. Which of the following is a disadvantage of facultative reinsurance? A. It is typically less flexible than treaty reinsurance. B. It does not allow for the ceding company to select specific risks for reinsurance. C. It can be costly to negotiate on a case-by-case basis. D. It automatically covers all risks within the treaty. Answer C. It can be costly to negotiate on a case-by-case basis. Explanation. Facultative reinsurance involves negotiating reinsurance on a case-by-case basis, which can be time-consuming and expensive. This type of reinsurance allows insurers to select specific risks for coverage, providing flexibility but also requiring more effort and cost per transaction. In contrast, treaty reinsurance is more cost-effective but automatically covers a portfolio of risks and the terms are agreed upon in advance. Question 12. What is the main purpose of using a retrocession in the reinsurance industry? A. To provide a final layer of reinsurance for the primary insurer. B. To enable the original reinsurer to transfer part of their risk to another reinsurer. C. To allow reinsurers to share profits with the ceding company. D. To limit the amount of premiums paid to the ceding company. Answer B. To enable the original reinsurer to transfer part of their risk to another reinsurer. Explanation. Retrocession is the process by which a reinsurer transfers part of the risk they assumed to another reinsurer, known as a retrocessionaire. This allows the original reinsurer to reduce their exposure to risk and manage their capital more effectively. Retrocession is commonly used by reinsurers to further spread the risk they have taken on, creating a layered approach to risk management. Question 13. Which of the following types of reinsurance agreements would typically involve a fixed percentage of premiums and losses being shared between the ceding company and the reinsurer? A. Quota share reinsurance. B. Excessive loss reinsurance. C. Surplus share reinsurance. D. Facultative reinsurance. Answer A. Quota share reinsurance. Explanation. Quota share reinsurance involves the reinsurer assuming a fixed percentage of both premiums and losses from the ceding company. This type of reinsurance agreement is often used to provide a stable relationship between the two parties, with both sharing the same proportion of the risks and rewards. It contrasts with excessive loss reinsurance, where the reinsurer only covers losses above a threshold. Question 14. Which of the following would be considered a key feature of a treaty reinsurance agreement? A. It is negotiated on a case-by-case basis. B. It applies to specific individual policies rather than a portfolio of risks. C. It automatically covers a specified class of risks without the need for individual negotiations. D. It requires the ceding company to buy additional coverage for large claims. Answer C. It automatically covers a specified class of risks without the need for individual negotiations. Explanation. Treaty reinsurance automatically covers a specified class of risks agreed upon in the contract. The terms of the treaty are predetermined and the ceding company does not need to negotiate each individual risk. This provides both parties with efficiency and clarity as the reinsurer covers a portfolio of risks instead of having to assess each case separately. Question 15. What type of reinsurance would be most appropriate for an insurer seeking to cover a specific large loss resulting from a catastrophic event? A. Facultative reinsurance. B. Quota share reinsurance. C. Stop loss reinsurance. D. Excessive loss reinsurance. Answer: D. Excessive loss reinsurance. Explanation: excessive loss reinsurance is specifically designed to cover large losses that exceed a specified amount, making it ideal for covering catastrophic events. In the event of such a loss, the reinsurer would cover the amount above the agreed-upon threshold, providing financial protection for the ceding company. Facultative reinsurance could also be used for specific large risks, but excessive loss is the most common choice for catastrophe coverage. Question 16. Which of the following is a common reason for an insurer to use reinsurance? A. To increase the amount of risk retained by the insurer. B. To manage the financial volatility of large claims. C. To increase the amount of premiums collected. D. To reduce regulatory requirements for claims reporting. Answer: B. To manage the financial volatility of large claims. Explanation: reinsurance is used primarily to help insurers manage the financial volatility that can arise from large or unexpected claims. By transferring part of the risk to a reinsurer, the insurer can stabilize its financial position and ensure that it can meet its obligations even in the event of large losses. This helps to reduce the impact of catastrophic events on insurers' financial performance. Question 17. Which of the following best describes the relationship between a ceding company and a reinsurer in a quota share reinsurance arrangement? A. The reinsurer pays for losses exceeding a certain threshold and the ceding company retains the rest. B. The ceding company retains a fixed percentage of premiums and losses while the reinsurer covers the remainder. C. The reinsurer assumes all of the risk for a specific class of policies and the ceding company keeps the premiums. D. The ceding company and reinsurer share the losses from specific policies on a case-by-case basis. Answer: B. The ceding company retains a fixed percentage of premiums and losses while the reinsurer covers the remainder. Explanation: in a quota share reinsurance arrangement, the ceding company and the reinsurer agree to share a fixed percentage of both the premiums and the losses. For example, if the arrangement stipulates a 70% quota share, the reinsurer would cover 70% of the losses and receive 70% of the premiums. The ceding company retains the remaining 30%. This proportional sharing helps both parties manage their risk exposure. Question 18. A company faces a significant increase in risk due to a new product line and seeks reinsurance to cover potential losses. What type of reinsurance would be the best choice for this company? A. Excessive loss reinsurance. B. Surplus share reinsurance. C. Facultative reinsurance. D. Quota share reinsurance. Answer: C. Facultative reinsurance. Explanation: facultative reinsurance is best suited for covering specific risks, especially in cases where the insurer faces a sudden increase in exposure, such as with the introduction of a new product line. Under facultative reinsurance, the insurer can negotiate reinsurance on a case-by-case basis, providing tailored coverage for individual risks. This offers flexibility for handling new or unusual exposures. Question 19. What does the term ceding commission refer to in a reinsurance contract? A. The amount of premiums that the ceding company receives for transferring risk. B. The fee paid by the reinsurer to the ceding company to cover administrative expenses. C. The portion of the loss that the ceding company retains. D. The percentage of premiums that the reinsurer receives from the ceding company. Answer: B. The fee paid by the reinsurer to the ceding company to cover administrative expenses. Explanation: a ceding commission is a fee paid by the reinsurer to the ceding company in a reinsurance contract. It helps cover the ceding company's administrative expenses, such as underwriting and policy management. The ceding commission is typically calculated as a percentage of the premiums ceded to the reinsurer and can be negotiated based on terms of the reinsurance agreement. Question 20. Which of the following is an advantage of using reinsurance to manage risk? A. It eliminates the need for insurers to set aside reserves for future claims. B. It enables insurers to write more business without taking on excessive risk. C. It removes all regulatory requirements for insurers to maintain solvency. D. It guarantees that all claims will be paid in full without any risk to the insurer. Answer: B. It enables insurers to write more business without taking on excessive risk. Explanation. One of the key advantages of reinsurance is that it allows insurers to write more business and take on additional risk without exposing themselves to excessive financial losses. By transferring some of the risk to a reinsurer, the primary insurer can expand its capacity to write policies while maintaining financial stability. Reinsurance does not eliminate the need for reserves or regulatory requirements, but helps manage the overall risk exposure. Question 21. Which of the following is a key feature of surplus share reinsurance? A. The reinsurer covers all losses above a specified amount. B. The ceding company retains a portion of each risk while the reinsurer covers the surplus. C. The reinsurer assumes only high-risk policies on a case-by-case basis. D. The reinsurer and ceding company share premiums and losses on a fixed percentage basis. Answer. B. The ceding company retains a portion of each risk while the reinsurer covers the surplus. Explanation. In surplus share reinsurance, the ceding company retains a portion of each risk up to a specified limit, its retention limit. Any risk above that retention limit is transferred to the reinsurer. This arrangement is used for risks that are too large for the ceding company to retain entirely, but not large enough to require excessive loss reinsurance. Question 22. Which of the following types of reinsurance would be most beneficial to an insurer seeking to protect themselves from volatility caused by large but infrequent claims? A. Facultative reinsurance. B. Stop-loss reinsurance. C. Excessive loss reinsurance. D. Quota share reinsurance. Answer. C. Excessive loss reinsurance. Explanation. Excessive loss reinsurance is designed to protect insurers from large but infrequent claims often associated with catastrophic events. The reinsurer covers losses above a specified threshold, helping the insurer mitigate the financial impact of a single large claim or event. Question 23. In a quota share reinsurance agreement, what is typically shared between the ceding company and the reinsurer? A. Only the premium payments. B. Only the loss payments. C. Both premiums and losses. D. Only the underwriting risk. Answer. C. Both premiums and losses. Explanation. In a quota share reinsurance agreement, the ceding company and the reinsurer agree to share a fixed percentage of both premiums and losses. This proportional sharing helps the ceding company manage its risk while giving the reinsurer a portion of the business. Question 24. What type of reinsurance agreement is typically used to cover the risks of an insurer's entire book of business rather than individual risks? A. Facultative reinsurance. B. Treaty reinsurance. C. Excessive loss reinsurance. D. Stop-loss reinsurance. Answer. B. Treaty reinsurance. Explanation. Treaty reinsurance involves a comprehensive agreement that covers an insurer's entire book of business or a specific class of risks. The terms are agreed upon in advance, and the reinsurer automatically assumes a specified portion of the risks without the need for case-by-case negotiation. Question 25. What does the term retention refer to in reinsurance? A. The amount of risk transferred to the reinsurer. B. The amount of risk the ceding company retains after reinsurance. C. The percentage of premiums the reinsurer receives. D. The payment made by the ceding company to the reinsurer for reinsurance coverage. Answer. B. The amount of risk the ceding company retains after reinsurance. Explanation. Retention refers to the amount of risk that the ceding company retains after reinsurance. It is the portion of the risk or loss that the insurer is responsible for covering, while the reinsurer takes on the remaining portion according to the terms of the agreement. Question 26. In excessive loss reinsurance, which of the following is covered by the reinsurer? A. The entire loss amount, regardless of the loss size. B. Only losses above a specific threshold. C. A fixed percentage of the loss. D. Only the premiums from the policies affected by the loss. Answer. B. Only losses above a specific threshold. Explanation. Excessive loss reinsurance covers only those losses that exceed a predefined threshold, such as a certain dollar amount or percentage of loss. It is used to protect the insurer from large catastrophic losses and is not a proportional arrangement like quota share reinsurance. Question 27. What is the primary benefit of facultative reinsurance for a ceding company? A. It provides automatic coverage for an entire portfolio of policies. B. It allows the ceding company to choose which risks to reinsure on a case-by-case basis. C. It eliminates the need for the ceding company to maintain reserves. D. It guarantees that the reinsurer will cover all losses above a set threshold. Answer B. It allows the ceding company to choose which risks to reinsure on a case-by-case basis. Explanation. Facultative reinsurance provides flexibility for the ceding company by allowing it to select specific risks to reinsure on a case-by-case basis. This is particularly useful for unique, high-value, or high-risk policies that require tailored reinsurance coverage. Question 28. Which of the following types of reinsurance is most suitable for an insurer that wants to limit its exposure to a catastrophic event affecting a specific class of policies? A. Facultative reinsurance. B. Quota share reinsurance. C. Excessive loss reinsurance. D. Surplus share reinsurance. Answer C. Excessive loss reinsurance. Explanation. Excessive loss reinsurance is ideal for limiting exposure to catastrophic events as it provides coverage for losses that exceed a specified threshold. It is typically used for risks that could result in large infrequent losses, such as natural disasters or large-scale accidents. Question 29. What is the purpose of a ceding or reinsurance contract? A. To increase the amount of premiums the ceding company collects. B. To reduce the amount of claims paid by the ceding company. C. To transfer a portion of risk from the ceding company to the reinsurer. D. To guarantee the reinsurer will cover the full loss. Answer C. To transfer a portion of risk from the ceding company to the reinsurer. Explanation. The term cede refers to the process of transferring a portion of risk from the ceding company, the insurer, to the reinsurer. This is the primary function of reinsurance, to spread risk and help the ceding company manage its exposure to large or catastrophic losses. Question 30. Which of the following best describes the concept of cession in reinsurance? A. The amount of risk the ceding company keeps for itself. B. The transfer of risk from the ceding company to the reinsurer. C. The payment made by the ceding company to the reinsurer. D. The share of premiums paid by the reinsurer to the ceding company. Answer B. The transfer of risk from the ceding company to the reinsurer. Explanation. Cession is the act of transferring risk from the ceding company to the reinsurer. This process is a fundamental part of reinsurance, allowing the insurer to reduce its exposure to risk by sharing it with the reinsurer. Cession refers specifically to the portion of risk that is transferred to the reinsurer under the terms of the reinsurance agreement.